All right. So once again, thank you all for joining tonight's session for our financial literacy webinar. Tonight we'll be discussing rules of the road. My name is Chase Jackson. I'm the director of Bigger and Better Business for the Omicron Sigma chapter, or the North Dallas Sigmas, as we are known. And tonight we have on once again LaShondra Strother Wiley. She is a partner with Edward Jones and a great investor, investment knowledge, and know-how. So, LaShondra, if you will, take it away for us, and we'll be listening and taking notes.
All right, great. Hello, good evening, everyone. If we're all in the Dallas-Fort Worth, it's been a rainy evening. Hopefully everyone's safe and things are going well. I know I've had some challenges myself this week, but I just wanted to say it's great to be here. Again, my name is LaShondra Strother Wiley, and I am an Edward Jones financial advisor. I am located in Arlington, Texas. And I've worked here at Edward Jones as a partner. I've been here over 12 years, almost 12 years. And I've lived in the community about 23 years. So I did become a financial advisor just because I have passion for helping people reach their goals and their financial quest for a good future, right? So my goal is to educate you tonight as much as I can. That's a big part of how I work, and that's what I really enjoy most, to help you be able to accomplish your goals. Okay, so we're going to get started, and that's my welcome. Let's talk about the beginning of where I want to go with you today, because we're going to bring this into a two-part series, I believe, because it's for rules of the road as being an investor, and then we'll also talk about if you're a business owner and some of the challenges of having a business and what to do with that. So I will kind of go through this, and it recaps a little bit even about what we talked about last week in today's meeting, just some principles of investing that can help you towards your goals and avoid some of the common mistakes that happen in investing. Okay, so these 10 rules of the road are guidelines that I've learned as being a financial advisor. Here at Edward Jones, I've worked with clients and watched the financial marketplace go through many, changes, but it's been valuable. And there's some the principles that I want you to know about achieving success and avoiding some of the problems. So let's get started with some of the first rules. Okay, so the first rule is to develop your strategy. Okay, successful investors require deciding that you're trying to achieve your goals, right? And you're outlining your steps to get there. It also requires some discipline and a little patience. So that's why I recommend having a documented and written investment strategy to help provide all of these, right? All these things. So before a financial advisor can really discuss an investment strategy, they should get to know you first and understand what you want to accomplish. That's because your financial strategy should be based on you. It should be customized. There's nothing more important than understanding what's important to you. Only you can work with the financial advisor and build that personalized strategy, and it works on your specific needs, okay, to achieve your goals. So we want that. So as far as your strategy goes, it should be based on your long-term goals, your length of time to invest, which is also known as your investment time frame or your life stage, okay? Your comfort level with risk, and the steps required for you to get there. Be specific. When you when you have a written strategy, you need to be specific. You write it down, right? That makes it achievable and believable. And then the more you can outline what you are trying to achieve, the more you can tailor your strategy to your needs. Then you probably have, several long-term investment goals, and I'm sure you have some short and middle, and those can be put in different buckets. But these should include your retirement, maybe paying off your child's education, or protecting your family's financial future should anything unexpected happen. Okay, so this is what you do, you outline that, okay, and maintain it. That's why it's so important that you work with someone, you work together, you get an advisor to help you outline and prioritize your goals. Okay, you may need to make some trade-offs though along the way, because there's no free lunch. The strategy can serve you as a guide and help you also to maintain your goals and be on track. There's going to be periods where the market's going to be up, it's going to be down, but in addition to kind of helping you develop a strategy, a financial advisor can also help you maintain discipline and provide guidance to maintain a focus and avoid any short-term distractions along the way that come up. Your advisor is also your partner, so you and your family throughout your life, you need to be revisiting your goals. You need to look at what your risk tolerance is, okay, as well as strategies that help you, develop and grow and help you keep on track towards your goals. Okay, now that we're discussing these strategies, let's turn to what the second rule is. Okay, so the second rule is understanding risk. And you've likely heard about risk versus reward. Risk and return generally go hand in hand. The higher the return potential you want, making the money, the more risk you'll have to accept. And what that really means is volatility. Can you stomach the ups and downs? Okay? When it comes to investing, it's crucial that you understand risk, but it does not help you. You don't lose sight of what should be the biggest risk. And I kind of got tangled up here in my suit here. See, so it is crucial that you understand it. So the bigger the risk you're facing in investments, it depends. It could help you to not reach the goal. So we want to make sure that you're reaching the goals. Okay? And there's several types of investment risk. There's economic ones, the economic risk. There's also there's interest rate risk, inflationary risk. That's just a few. However, many investors often think of risk as the potential for declines.
And Chandra, I have a quick question.
Mhm.
So when it comes to investing and speaking on risk, so how do you teach your clients or others how to not become so emotional when it comes to investing? Because we know with some stock market, it's an emotional game. How do you help others to not become so emotional?
Yeah, it is emotional because I know if you look at it and you see it's down, I say take a deep breath, but don't look at your statements every day. If you have put together a strategy, we have to give it time to work, right? So you give it time because the investments aren't bad. If you sell off, that's a permanent solution. That's like suicide. It's called financial suicide. The companies aren't going out of business tomorrow just because the prices are down, your portfolio low. You're just allowing them to stay the course and maybe dollar cost average. One of the things I always say is you can look at your statement and you might have a brick in your hand and you have a brick and you might want to just throw that brick, just throw it, do something. I don't care what you do, go garden, you throw it, but have a check on the end of it. Okay, because
Right.
if it is volatile, you should be buying. That is your biggest buying signal in investments. Okay, buy low, sell high, but it's hard for people to do because of emotion. So the role as an advisor is definitely to manage your emotion. And that's a great example, right? Because it might not be good to just have a lot of cash in their portfolio. Many investors often think risk as the potential, is the potential of declines, but risk means more than just the potential of the fluctuation in value. Okay, it could be that you have too much of one thing, too much of a sector, right? You don't want that. That's why you want diversification, and that's the best way that you avoid the emotional roller coaster, right? So it's all appropriate to that. Okay. But I'd also want, I'd say the growth potential is you need to have the investments so it keeps up with inflation as well. We all been to the grocery store and saw those steaks. If you eat red meat, it's not cheap. $10, $15 steaks and all that 20, that's inflation. So that is why your money has to grow and you have to have ownership in companies because that's what keeps up with inflation. Okay. So what's your comfort level with risk? These are the questions that you have to ask yourself. Understanding this can help you keep up and determine how you may react to the market ups and downs. Okay, all of this is over time. Okay. Second is how much risk are you able to take? That's the amount of time you have to invest. Okay. It plays an important role too in determining how much risk you're able to take. Okay. How much? What would make you have a breaking point, right? What is that? Okay. And then how much risk do you need to take? 3 different questions. You also want to determine the return and therefore the risk. Okay. That will make the necessary arrangements or adjustments to reach your long-term goals. So the comfort with risk, how much can you take and how much do you really need to take? Okay. But of course, we want to take as less as we can to still reach your results. And then that's when you also get with your advisor to help you, and they can help you avoid making the biggest risk that you face by not achieving your goals. And so, if you get someone to help you to determine the strategy, it'll protect you against the unexpected events, okay, that could come up and to derail you or take you off track. That's why you want to get with a professional, right? And the other key is diversify. Diversify for a solid foundation. The foundation of your portfolio is your asset allocation. Okay? And you see that in a lot of your 401ks or you might have your IRAs. Asset allocation is the diversified mix of stocks, bonds, cash, international, and other assets, all the asset classes. They're tailored for your solution and they're designed to support your long-term strategy. Okay. It's not, some people just do these target date funds in your 401k, but they have a lot of other ones there. And we got to miss that class before we're about to come back in now your 401k. You want to make sure you do look at the performance summary so you know what's there. Okay. That's a part of the diversification. You can read across the 1 year to the 10 year to see what best in class investments are there. So the diversification, though, does not ensure a profit or protect you against loss or decline in markets because it still may waver. Okay. But it can help you it provides a smoother ride over time by reducing swings in the portfolio, the higher dips. So when a single investment asset class performs poorly, it's a disappointment, but it's not a disaster. It's not the end of the world. Right? It's just a disappointment. We can pivot. When it comes to diversification, start with your mix of stocks and bonds. Stock prices tend to fluctuate over time, but historically, they're going to have higher returns. Bonds tend to fluctuate less. But anyone that saw those in this last year or two saw that they're late to the party right now. This is a great time to buy, but you typically they provide lower returns. So if there were lower returns, then they don't correct as fast. So since stocks and bond prices, they often move in opposite directions, it's like a teeter-totter, combined then they may help reduce the swings of your portfolio. So that's why you need them both, because they really are supposed to balance each other. Okay. So the mix of stocks and bonds will help your portfolio's return. and how to react to that. Okay, it's in different conditions they should help, and that's why you need to align your goals and your comfort with risk over time, because different types of stocks may not always behave the same. So, for example, international stocks don't always move in sync with domestic stocks. For the last, it really, we had 1 year out of 12 years where the international stocks have performed more, but they do have a season. It's cyclical. So you still want to have them there. They give you balance. Or you might have small cap or stocks that are in smaller companies. They can rise and fall at different times from mid to large caps. That's why you need diversification. But what about bonds then? What about them? The rates on bonds usually move up and down. They move up and down together. However, the US corporate bonds and the treasury bonds don't always rise and fall by the same amount or at the same rate as the high yield and the international. Because some of you have heard about some of the government bonds. They were the great things to be in at the time while the corporates were reset. That is why it is diversification in both sectors. That's why you need to have a broad mix. Okay. So when you incorporate those together, you have to then stick to quality. Okay. Overall, the factors considered investing, we need to believe in quality. That is the most important thing, and it's often overlooked. Okay, most important. For most investors, there's an easy way I'd say you can measure quality, but for most, it takes some work. Since stocks have a larger price fluctuation than bond investments, quality is frequently measured by the steadiness, the earnings, dividend growth over time. Since your total returns in a combination of dividends and capital gains, those exist. Okay, you need those investments, okay, in there. And bonds, the measure of the quality of bonds, the investment grade, that's the rating on them. If you've ever looked at a prospectus, it'll give you grades like A rating, a B rating, and all of those, right? That indicates to the borrower if that company kind of has a good track or record of making the promise of the interest or the principal payments, just like a mortgage. Okay, the quality also means that these investments are more likely to overcome temporary challenges, which is why a good track record can be an indication of the quality, how they have performed, how they're rated. Okay, if you've received any tips on today's hot investments, especially if they've already performed well, you might have heard about some things this week in the media, some splits and things like that. The best advice we can offer is ignore some of that, because if it's already there, it's a run on it's probably too high. But I'm just saying that's one thing. So although it may be tempting to buy a particular investment, it may not fit the rest of your portfolio, and it may be riskier than you expect. So if it sounds too good to be true, it possibly, but we know that one is, right? Possibly is. It may be tempting to look at investments offering the highest dividend and interest rates, but there is no perfect investment. The higher the rate of the yield, the higher the risk most often. So let's turn from quality and let's give a perspective on the investment long term. Okay. Why you invest in the long term? Okay. Well, I can tell you the most successful investors make their money over time. Okay. It's not a microwave. We believe mostly consistent, successful investments is owned by a well-diversified portfolio, quality investments, and to plan to your own, goals. For the long term, that's what you should do. One of the biggest mistakes investors tend to make is trying to time the market. You cannot time the market. This may involve moving money into, is there a question? Okay. This may involve moving money into or out of the market in response to short-term declines and the latest predictions. But unfortunately, this usually results in getting into the ins and outs of the market at the wrong time. It costs you a lot of time, both time and money. But you can't always make that up. And it can result in lower returns over time. Because typically when people do that, they come in and out trying to time it. They're losing because you missing the day, you're missing the time. So maintaining, that's what the long term really means, just a perspective. It can help you ignore the constant noise that you hear in the markets and you stay invested. You stay the course. You revisit though, you're looking, you know, that's why it's recommended that you own diversification in the portfolio of your goals, looking at the risk. This can better prepare you for the weathering the storms, potential short-term issues that happen in our economy, in the market, just like when we just had the pandemic. And there's a firm that a lot of self-managed accounts that were over $1 million, 30% went to cash, long time. Because like I said, within 9 weeks it was up, and then that's 30% loss locked in. You didn't make it up. Those that stayed the course, they were up extra 30. So it's things like that. That's why over time your goals may change, but on certain investments they may not work out. You may need to replace them, but that's what we do. Look at it, and we may just move the furniture around some, right? But it's important to make changes for the right reasons, not just simply because the stocks or the investments may have dropped in price. That's not a strategy. Okay. And generally, you don't sell quality investments that might have recently underperformed, but still they play a key role in your asset allocation. It's just temporary. Okay. Remember, investments don't move up and down at the same time. That's why diversification can help smooth the ups and downs of the market. Keep a long-term perspective and your goals in mind while reviewing the performance of the individual investments for your overall portfolio strategy. Okay? And set realistic expectations. Set these expectations because these are the performance. They have a big effect on your strategy, okay, about how the investments will perform. You think about that. You need to be realistic. We believe in setting the realistic expectation to help you accurately track what your progress should be. Ultimately, you will achieve your goal. That's the key. What is the goal? Can you achieve it? You set the right expectation. You first need to determine, and then the return. You need to know what you're trying to achieve. When you do that, it helps you in kind of having that knowledge base and understanding of what it is. You know, this is why it often doesn't make sense when you compare your return to the market index, such as the S&P 500. Okay, when you're comparing it to the S&P 500, do you own all those companies in the S&P 500? So unless you own the S&P, then the index is not built with your goals or your risk tolerance in mind. It doesn't have that piece on it. So your return expectation should be based on the asset allocation, as we discussed in the number 3 rule, okay, as well as the market environment and your investments for that time frame. So your financial advisor, okay, or if I was your advisor, I would say, okay, well, can we help? How can we review your performance in the context of your long-term goals? And like with Edward Jones, expectations is for it's for future performances. It's not always just right now what's there. More importantly, you should review it and how the performance affects the progress towards your financial goals. This will help you determine whether the changes need to be made or do you need to just keep on track where you are. Okay, or we get you back on track. Okay, so after you set your expectations, the next step is to work to achieve them. To help you achieve the goal, these expectations, you have to remember these things. Don't count on averages. Again, focus on long-term average return when developing your strategy. Remember, the markets rarely experience average years. Some years are up, some years are down. Short-term declines are normally part of investing. And don't chance performance. We've all heard that we shouldn't follow the crowd. But if you can't, but it can be very tempting. If we have kids, we know that to chase performance, it's tempting. This can lead to buying what you already had. It's already risen in value. It's already at its pinnacle or its peak, and then selling after it's already fallen in value. So you missed it on both sides, right? That's a recipe for underperformance. So let's talk about the 7 rule, number 7. Trying to get through this. You guys, I think we're doing good then on time. So maintaining your balance. Right? This means balance can be important in many areas of your life. We strive to balance work with play. I know I do. You want to have, it's like work-life balance, but still, I don't know if I've mastered that one yet. I'm working on it. Work-life balance. So we know the importance of a balanced diet. Working on that one too. The same can be said for your investments, though. That's why it's important to work together to achieve your investment mix on a regular basis. When developing a financial strategy, we focus on asset allocation. As I mentioned that earlier, this is designed to align your comfort level with risk and it positions you to achieve your long-term, financial goals. But depending on how your investments perform, your portfolio allocation can drift from the initial objectives. That's why we do what's called a rebalance. Right? This means your portfolio may no longer be positioned to accomplish your goals. So in other words, you could be taking too much or potentially too little because people that were too conservative during this last year or two didn't do well either. Too conservative. So the risk level of your initial objective, you might be some alignment. For example, if your stocks outperform for several years, right, you could end up holding more in the stocks than you initially intended because it's done well. So you have to shave that off. That's what rebalance is. You reallocate your investments to reduce the areas that were overweight, or you add to areas that were underweight. Rebalancing your portfolio regularly can keep your portfolio aligned with your goals and comfort with risk, and can help take emotions out of the investment decision because we have a strategy. Makes sense, right? Having a strategy. But rebalancing, yeah, that's good. But rebalancing can run counter to emotions because it doesn't make sense. You thinking in a natural mind, why, if it's doing so good, it's doubled. Why do I need to sell some of it and rebalance? It counters your emotions because it doesn't have to make sense, but that's the way you stay the course. It can force you to sell some of the investments that have performed well and add to asset classes that are underperforming. But again, this is a part of buy low, sell high. Even though it may be somewhat counterintuitive. If you don't rebalance proactively, the market tends to do it for you. And it's not going to be at the right time, believe me. Okay. It's during the market downturn. So you didn't capture your gains, right? This can be a very uncomfortable and many times costly process. By rebalancing on a regular basis, you can ensure your portfolio remains aligned with your portfolios. This can help you maintain and be on track to reach your long-term goals. And then we can go and discuss the next rule. Right?
Is there a business rhythm that you suggest to realign?
Is there what now?
A time frame, like what's the
Yes.
like
Yes.
cadence?
Well, it depends on you, but at least minimal once a year. You need to be looking at it once a year. It may be quarter. There's some programs that align automatically. They're available that way. We have the the artificial intelligence or the alignment. Once it goes out of the parameter, it'll adjust automatically. And it's like that in some of your 401ks. It'll say as needed. You can check that box. Or it'll ask you, when do you want to rebalance? When you go and redo your portfolio, and it might say once a year. But I like to do it as needed. And it that means it's always in tandem. It's always in sync. Does that make sense?
It does, yes.
Yes, thank you.
Okay. No problem. And of course, you can always sidebar, contact me if you need some more help or look at it, right? What you have. Okay. So let's talk about not just what you make, it's what you keep, right? So once we make it, I want to make sure you can keep it and protect it. So one of the other rules as we come down to rule number 8 is preparing for the unexpected. Are you caring for young children? You ask yourself that, okay? Are you getting ready to retire? Are you planning for your legacy? Okay? At any stage of life, there can be an unseen event that can occur. And that could derail what you've been working so hard to achieve. So it's important to be able to adapt to the unexpected. And while you can't predict the future, we can prepare for it. Okay? So how do we do that? Okay, let's talk a little bit about prioritizing and protective strategies. Okay, first, it's your home, right? It's your health, your family. You start by protecting your home and means of transportation and having access to health care. This allows you and your family to live in your daily life. Strategies could include homeowners or renters insurance, auto insurance, your health insurance, your state documents, such as your wills and your power of attorney. And don't forget about asset titling. Okay. Don't forget the transfers on that, all of that. Okay. Next, you tackle strategies about protecting your income. This can ensure that you can afford your expenses, both expected and unexpected, even in the event of something like disability or unemployment. Strategies can include an emergency fund, short-term disability. You have to plan for long-term disability, insurance, and life insurance. Big advocate for long-term care, because that can wipe out your whole portfolio. And nowadays, a lot of employers don't even offer it. You have to go out to the market. If they do, you definitely make sure during open enrollment you check the box. Okay. And finally, you focus on protecting your assets, because your assets are there to fund your goals. You should avoid having to use them to pay for emergencies. Strategies could include a long-term care plan, okay, a revocable living trust, and an umbrella liability insurance policy. Okay. All of these, you keep in mind that these strategies, you need them. You most likely involve using them over time, or your situation or your goals could change. it's been a while, but you may want to, if you know, if it's, I'd say at least every year or two, but you might want to review your strategy to see if you're still meeting, if it's still meeting your needs, right? By preparing the unexpected, analysis, building your strategy to address it. You know, you get a better position, a handle on the inevitable bumps that might come along the way. But you just want to make sure that you can focus on that and have a plan of action. Okay. Then number 9 is focus on what you can control. I talked about this as well, but earlier in the month, last month. But when investing, there are some things that you cannot control. For instance, you can't influence day-to-day market fluctuations. Okay, you can only prepare for them. The economy or the political environment we're in. Doesn't matter who's president, companies are resilient, believe me. The good news is that, you know, you don't have to worry about that. Too often investors, they can become distracted about the latest headline and what the news is saying on the expert predictions. They don't know they're invested too, just like you are. You know, we believe one of the keys in investment and success is to ignore these predictions. Because if they had a crystal ball, then they'll be rich, everybody be following them. Just think about it. Instead, base your decisions on time-tested investment strategy principles. That includes diversifying your portfolio, owning quality investments, and maintaining a long-term perspective. It's simple, but hard for some people to do. They're very simple. Okay. What often prevents investors from reaching their goals is not market fluctuations, but the reactions to the fluctuations. They tend to buy when the markets are up and they feel good, and then they sell during declines, moving into cash when there is a lot of fear. This essentially buying high and selling low is not a surprise, but it's not a successful long-term strategy. So Warren Buffett, who I follow, and I love Warren Buffett, he's in his 80s. He always says, when people are fearful, be greedy. When people are greedy, be fearful. I love it, but it's hard for people to do. I mean, that's your buying signal right there. When people are fearful, be greedy. Okay. The key is not to let your emotions control your investment decisions. So when you see this, when it, you know, an inevitable economic, political, or market-related shock occurs, you ask yourself, how does this affect my long-term goals? If your goals haven't changed and the events don't change, our outlook here at Edward Jones is that probably it isn't a reason to make changes to your strategy. In fact, these declines often present good opportunities, the Warren Buffett story, for long-term investors. We recommend that you use these declines to your advantage. You take that home today, and that is the key. Okay? And now let's look at the 10th and final rule. Okay? Review your strategy regularly. It's one constant thing you can expect, okay, is change. Your goals will change over time. Your life can change over time. Whether it's a new job in addition to the family, retirement, or something unexpected, your strategy will have to adapt. You know, and nowadays it's not even just children. We bring in our parents and senior living. I mean, I have elderly in-laws. Okay, this is where you have to look at this. This is where your review becomes very important. Developing your strategy is the only thing in the beginning. With your financial advisor, you review the strategy with that person on a regular basis. That's what we do. Again, your goals can evolve. They can evolve. They can evolve. They can change over time. Your strategy you might need to adapt. We'll pivot. But even if your goals don't change, you want to review them in the context of your investment performance to ensure that you still can stay on track and we rebalance when necessary. As the question was asked earlier. It depends, but if you need to look at it to see if it needs to be rebalanced. And during each review with your financial advisor, we'll work together. You help to ensure your portfolio stays and still is in alignment with your objectives and your comfort with risk. But that's not the only thing that you need to address. You also want to discuss and review other items such as your insurance coverage, your beneficiaries, and help ensure that these things continue to adapt to your needs over time. If something changes, make sure you update it. You may determine that you're on track or decide that you may need to adjust and get back on track. This is an ongoing basis, but you need to do it. Okay? But you don't have to do it alone. Remember, your advisor should be able to help you to be a long-term partner. It is a relationship. It is like a marriage. By working together on a regular basis with your strategy, you can make adjustments when needed, and you can have a clear picture of where you stand and where you need to be in order to reach your goals. So those are the 10 rules. So let's recap. Rule number 1 is to develop your strategy, right? We recommend having a documented, written investment strategy, especially tailored to your goals. Understanding your risk is rule number 2. The biggest risk you face when investing may not be reaching your long-term goals, but understanding the trade-offs between the risk and reward, your comfort level with risk. You must risk. It's really, I'm sorry, on how much you risk. You may be able to take the amount of your risk you need to take that it takes to reach your long-term goals. And then rule number 3 is to diversify for a solid foundation. Diversification does not ensure a profit, okay, or protect you against loss in declining markets, but it can help you provide a shorter ride, a smoother ride over the time by reducing the swings in value. Sticking to quality is rule number 4. For stocks, focus on steadiness in earnings and dividend growth over time. For bonds, your measure is the quality of a good track record for making promises on their interest and principal payments. That's the bond. Rule number 5 is to invest for the long term, trying to time the market. I talked about that. Can be a recipe for disaster. Maintain a long-term perspective and make changes for the right reasons, not simply based on price fluctuation. And setting realistic expectations is rule number 6. This can help you accurately track your progress and ultimately achieve the long-term goals. Rule number 7 is to maintain your balance. Working together to review your investment mix on a regular basis can help you ensure that you stay on track. And preparing for the unexpected is rule number 8. You can predict the future, but you cannot predict the future. You cannot predict the future, but you can prepare for it. How you address the unexpected will evolve over time as your goals change. And rule 9 is to focus on what you can control. You can't influence the day-by-day market fluctuations, the economy, or the political environment, but you can control how you react. And finally, rule number 10 is to review your strategy regularly. Your goal will change over time, and your strategy may need to adapt. But even if your goals don't change, rebalancing may be necessary to stay on track. Okay? Those are the rules. Okay? Thank you for your time, Daryl. We'll go over some of the business woes here in just a second. We got about 10 minutes. I'll go through that. Does anyone have any questions? Because I know you've given maybe a lot of thought about these things before, and it just, it's just time. But I would like to open it for any questions.
I guess, can you give us a real quick overview of how do we go and buy bonds or invest in bonds? Is that coming in a future segment?
Yes, it can. We can pivot on that, but how you buy a bond, it's simple. They're in a 401k, they're structured in there and they have bonds. But you can actually buy individual bonds. You can buy municipal bonds with your broker, with your advisor. Municipal bonds are great. Those are tax free. They're like they're backed by school taxes. Those, if you all had to vote like we did in May, you saw all those $100 million, millions of dollar bonds, right? You ever think about who owns those? Okay,
Yeah.
you can actually buy those, though, and they're
So
backed
how,
by tax dollars.
so cost wise, what do they cost to buy? So what's your, I guess your range
$5,000.
of cost? Okay.
Then $5,000 increments, then 1,000 after that. So you start a bond with 5,000 and it's called at par, or you can have it discounted. I talked about that a little in the last segment, with par being whether it's a premium over the $100 par price is what that means, or it could be discounted as well, which means you're getting it on sale. And at the end of the maturity date of the term, you get your principal back. And you're making interest, and it can be paid out monthly or semi-annually or quarterly, but most bonds it's twice a year.
Good information. Thank you.
And Lysandra, I know you had talked about really being a proponent and fan of Warren Buffett. I am also myself.
Awesome.
So I follow his 90-10 or 80-20 rule when it comes to allocation for stocks versus bonds. Do you feel like that is a good strategy to follow, and something that's just kind of easy and consistent to build wealth over the long term?
Over the long term, Warren Buffett is a stock person, so am I. So for growth, if you're growth focused and it meets your time horizon and your risk tolerance, absolutely. That's called growth. 80-20 or 90-10 is growth focused portfolios.
Okay.
I particularly like that. And again, if you can stomach the fluctuations, because that's going to fluctuate more, but it could go up and down faster, right? But in the long run, are the returns greater? Yes.
Okay. All right.
Yeah. Well, yeah. Love to talk more, but yes, those are perspectives. Some people are more conservative. So that's why we have to look at what all you own. Okay.
Thank you.
You're welcome.
Good evening. This is Thomas Smith. How are you?
I'm well.
Really enjoyed your presentation. Thank you so much. I'd like to get your thoughts on real estate investments. I've increased and diversified my investments, particularly over the last 10 years, and that's worked out really well for me. I'd just like to get your thoughts on REITs versus direct investing, and sort of, just hear what you had to say.
Well, it is a sector. It's a specialist section. We're talking about REITs, real estate investment trust. I think a piece or a section of that is perfectly fine. I love the O, which is one of the tickers code, but like anything else, it has a season. It has its ups and downs, so it should be just a part of your portfolio, part of your asset allocation. And as far as owning real estate in itself as a whole, if that's the question too, absolutely. I mean, that's another income environment. That's just like a bond investment, right? You're living off of the income or the interest and protecting the principal or the real estate and developing an income stream until you're ready to sell it. And I have a lot of real estate investors that have real estate over the years, but as you get older, of course, that's taxing because it is still work on you. Even if you get a management company, it's a business. So there's points in a portfolio. Sometimes you might sell that off and then put it in investments that also produce you income. And there's other ways to do that in making your own pension or things that are brought up from a pension is like an annuity, and that can also produce incomes for you as well. But have no problem with REITs or real estate.
Thank you.
Thank you.
All right, thank you, Brother Smith. When you get that vacation home, Thomas, let me know. All right.
Hey, he'll bite us off for the party. Okay.
Don't worry about it. I'll need somebody to cut my grass, Jay.
So, any business owners out there, by a show of hands, is there any business owners that want to kind of go through quickly this exit planning? Or give you some quick tips on?
Budding business owner, how about that?
Brother Heron, I'm gonna tap you on the shoulder.
So what is the exit plan? Yeah, so this was a quick one just to kind of go over where I have a strong certification in. It's called a CEPA license. So I am a certified exit planner advisor. I help companies, I implement 401ks, and simple IRAs and, you know, all investments, buy, sell agreements, all of those, right? So that is a part of business. So what is exit planning? Why start exit planning? How to start? Well, you should start from day one. I tell people that. So it's like, what does that really mean? So let's talk about it. Hold on, let me get it up here. But let's talk about it here. So you need to have a process as soon as you start your business. Okay, you need to identify what your personal goals are in that business, financial, and your business needs. So these are some of the things that I talk about and help owners to really be confident and develop on a plan. If they're privately held, typically you want to make sure that your company can grow and eventually not have you as the primary reason why it's successful, right? Because people don't want to buy a company where they need you, right? So the advantages of a comprehensive and effective strategy are these: having goals, you know, for your transition in your life, you know, how you're going to sell the business, identify what you're going to do even after the business. You know, I'm gonna give you some statistics, and 70% of the people that sell their business, they get depressed after it because they didn't have a plan of what they're really gonna do next, or they were so used to solving problems and they didn't think about, you know, what they were gonna do in their life plan. So you need to identify that, and you need to prepare a successor. Right? And highlight ways to increase the value, the marketability is called the EBITDA of it. You know, address tax and legal considerations and contingency plans. Should the owner be forced to step away, sure, you usually don't plan it. Okay, so some statistics: 80 to 90% of business owners' net worth is in their business or in their real estate. Okay, and 80% of businesses put on the market do not sell. I don't know how many people have inherited a business and they couldn't sell it. They just had to sell off equipment and all that. It wasn't an actual plan, right? And 50% of exits are involuntary due to unforeseen circumstances, usually a sickness or something, or, you know, certain things happen and they have to move away or whatever. So they're 50% of the time, they don't see it coming. So decisions made today could impact your ability to exit the business. So the thing is, you want to do it on your terms, right? Exit plans can make informed business strategy, provide context for your decision making, provide the opportunity to improve evaluations on your business. You can get your business evaluated. Once you establish your business, it's basically your report card and how you fare to your competitors. Yes, that's a evaluation of where you are on the spectrum of the playing field. Are you low value? Are you best in class? Are you somewhere in the middle? And there's a rating. And the key is, if you want to get to that rating to get the biggest bang for your buck, you want to move up to that no. And that's how even your competitors buy your business, right? So your exit plan may have implications for who you hire, how you invest in your business, how you finance operations, all of that. Okay, and having an exit plan can help you prepare for the unexpected. Death, disability, disaster, divorce. That's a big one. We call all the D's, all the D words. This is all the 4 D's, the 5 D's: death, disability, disaster, divorce, disagreement. So what that debacle's the plan, right? So you want to make sure you have help to comfortably evaluate what this is an unsolicited offer. So if you get an offer for the business, you want to make sure it's a good offer. Okay. So the way we do it is build a professional team with your financial advisor. I'm the kind of the coordinator of that. Many business owners benefit from coordinating or having like a quarterback, they call it. It's like a quarterback in your business. It's where you have your advisor, your tax professional, your legal professional, commercial banker, and business valuation specialist. And we also do evaluations for certain businesses if they're at that level.
And
Okay.
Sandra, quick question.
Mm-hmm.
On that slide there, let's say if we want to work with you, for those who have businesses that want to work with you, is that a separate cost than what? So your already regular fees. If we have, let's say, a tax professional that we already are using, would you just incorporate them in that
Well,
plan?
I've worked with your team, but that's
Okay.
what's needed. Mm-hmm.
Okay.
We work together, and then if we have to bring a specialist on the outside, then you'll have a recommendation for that. We'll talk about that. If they're not astute into that role, or when you're ready to sell, because first it's called readiness. The company has to get ready, so they always need to be growing. So the mindset of business is just like your home. They say to have your home should look like you're ready to sell it every day, right? And a business is the growth. It should always be growing. So anytime something happens, an emergency, you already got everything laid out. The offer just has to be made. Does that make sense? Just like you're showing your house. Okay. You always want to have it ready to sell to get the value you want. So that's one of the big advices. And then you can also we can enlist some experts, kind of what you were just talking about, with specific knowledge to get more specialization into the business needs. So we talk about business brokers, investment bankers, but it also could be joint venture capitalists, legal professionals, ESOP advisors. An ESOP is similar to like a 401k plan, but it's where the employees actually have ownership in the company, and you can help, say, your key man employee get set up to be able to buy you out if you're setting them up for that, right? Where they have a way that they can come to the table with money and funds. Or sometimes it's a family member, a brother, sister, or child. How can they afford to really take over family business? You start an ESOP. Okay. So, and then a family business advisor and a value advisor. Okay. These are some of the specialists. Okay. Here is just how you can get help from start to finish, the legal, the tax. I'm the quarterback, as you can see in the middle. You work with the evaluation, the banker. You got to communicate the goals. So we have several in-depth meetings and, strategy meetings about, where you are, where you're going. You want to have those every 6 weeks or so on a regular basis with any business, and you address the breadth of all the financial needs. Right. Articulate the goals of what you want.
Quick
Think
question
about,
again.
I'm sorry.
No, quick question. So for the banker piece, is that just a commercial bank, or could that be private lending as well?
Could
So
be
the home-
private. Some companies are factoring and doing other things. It just depends. But to set it up for sale and growth, we want to be able to have that right banker in mind for that, right? When you're ready, from start to finish, and having that relationship. But when you get ready to sell, then you have a whole host because it's another team that are getting you ready to make you attractive to put on the market.
Okay.
Okay. And then when you're planning these goals, you think about the lifestyle you aspire to be. So basically, if your business is doing 5 million in sales, you get 4 times your EBITDA, that's what it's called. So you're trying to get that business to sell for $20 million, right? Well, is it really worth that compared to your competitors? You want to look at that, and that's one of the things that we talk about and I teach you. And then you to determine first what your number is, what you need, what you want. That's how you to get to the sale price, right? To have the lifestyle that you want. What do you need to consider in your lifestyle? Do you like traveling, golfing, fishing? What is that? Shopping around the world, consulting, working for business? What? You want to start buying other businesses with the money? You know, start other. What's going to keep you with that fulfillment? Okay, that's the key. And usually entrepreneurship, business owners love that they're able to afford other people to and keep their families fed and all those things.
I know that's right. Yeah, y'all doing a heck of a job with the podcast. It's wonderful as well.
Okay, so get a clear idea of your business valuation, your valuation of your goals, understand the business worth. So what I kind of talked about. Just get a clear understanding and consider getting a calculation value at least 3 to 5 years before you plan the transaction. So you can make the changes to get the number because you need time. And typically we start about 5 years out getting it ready for sale. Okay. So close the gap, step 2, 3, working, develop a strategy to close the gap between the steps, the steps 2 and 3, which is working longer, reassessing your spending needs, saving more outside of the business. It means you need a personal investment plan too, and looking for ways to increase the value of your business. All of that goes into your portfolio. Improve profitability by increasing your market share, introducing new product lines, increasing your prices maybe, and reducing your cost. May sound simple, but for some business, hard to do. They don't know where to start. Okay. Improve the company's intangible values by improving the depth, expertise, your personnel. It's not cheap hiring good talent, but it may be needed to get to the number you need. Having your right software and platform, CRMs in place, right? Systems and processing, and then good relationship with the customer. Okay. And these are the type of ways that you can sell the business. Consider the exit strategies, internal transfers. Those are sales within. Normally that's family members a lot of time, or your business partners, employees that buy. You don't normally make as much off of those, but you're doing that because these are the people you want your business maybe to go on with integrity of how you did it. Then that's how you incur this type of transaction, but you have to get ready and get them ready to be able to help you to retire, right? Or to move on. So that's what an internal transfer is. And an external is maybe selling to a third party, unrelated. That's how you get the higher sales proceeds, right? That's how you get the bigger money, all right? That's that EBITDA, that 3-4 times is typically in this space, okay? Exit, and they need to make sure that you can only need to stay on for maybe that year or so because they want you to exit out. And they may need your help in the beginning. That's why the plan needs to be there where the business can run without you. Okay. And you have a great business operations and culture. And the third one is not the best, that's liquidation. Okay, that's when you got to liquidate, selling your assets to the highest bidder. This gives you the lowest proceeds from your business. Okay, the most disruptive, kind of the worst way to end. But as you saw, 50% of the time that happens. So we don't want you to be a statistic. And I think I put up the wrong one because my name and is on this, but you know me, so that's it. I'm 5 minutes over. I'm sorry, but we had a lot to cover. Thank you. I hand it over to you, Chase.
Alrighty. Lashandra, great information once again. Really enjoying good sessions. Looking forward to the future ones to come. Ladies and gentlemen, thank you once again for joining this session, our financial investment webinar. Once again, my name is Chase Jackson. I'm the Director of Bigger and Better Business for the Omicron Sigma chapter of Phi Beta Sigma. We are going to keep hosting these every 2 weeks. So if you give me one quick second, I will pull up the actual list that we have coming up.
Yes, I was gonna say, yeah, that for the next one is June 13th, right? Preparing
Yes,
for the
correct.
unexpected. And that's
Yes,
creating.
ma'am.
Mm-hmm.
Yes,
And
thank you. This is great information. I appreciate it.
thank you. And please, if you have any questions at all, I'll go to the top. You can reach out to me. I think Chase did send out my bio before. And Chase, you can send that out
Yes, I
again, or
did.
any information. I would appreciate any feedback. I have a feedback form that if you could please be honest, let me know that you liked it, didn't like it, what ways we can improve and be better. I would appreciate it, Chase. I can send that back out to you if need be, and I'd
Yeah,
love for you to
please
send
do.
it to the folks that were on the Zoom call today.
Yep. If you all do me a favor, put your emails in the chat for me, and I can get that sent out to everyone. But as of now, let me share this schedule.
Oh, let me stop sharing.
You're good.
Sorry.
I got it. You're fine. All right. Can you see my screen? I don't know which one's
Yes.
showing. Let's see. Make sure it's the right one. All right. So yes, for the next events we have, and it'll be the same link, but the next event will be preparing for the unexpected. That's June 13th, same time, 7 p.m. After that will be stocks, the nuts and bolts, June 27th. The next one will be focused on fixed income, tax-free investing. That's July 11th. And remove this retirement by design, move that one to, I believe, July 18th. If not, we'll set a final date for that. But no, these are
Yeah.
some great topics. Looking forward to the future knowledge that you'll be imparting on us, Chandra.
Thank you, thank you. Yeah, we'll look at those dates. I think I think July 11th will be right on the day I get back, but I should be okay with that. I'm traveling and coming back that day.
All right, just look, let me know. We can pivot. It's fine.
Okay. Yes,
All
we'll
right.
work it out.
Okay. Once again, ladies and gentlemen, thank you for joining, and we will catch you next time.
Thank you
y'all. Have a
all.
good night.
Good
Have a
night.
good night, y'all. Good night.
Good night.
Good night.